Welcome back. Uh, Today we will go into the second lecture in the module Portfolio Evaluation and Revision, and we will be discussing about Trainers Performance Index in detail. Uh, these are the different topics which I would be covering in this particular lecture. Now, the definition of Trainers Performance Index, which is normally called Trainers Ratio. Okay, so it is nothing but it is a metric which is used to evaluate the portfolio's risk adjusted performance, keeping in mind the systematic risk into the picture. So this is a measure to find out the risk adjusted return of your portfolio based upon only systematic risk. So it is talking about the broader market movement. If suppose unsystematic risk I am going to use, it becomes a micro level investigation. So I am not going into a micro level investigation, I am talking about the overall market. So this index is considered to be a better index if I am going to consider the return of individual portfolio in comparison to the broader market movement, market conditions. Okay, and this helps the investors to understand how the portfolio in which you have invested is giving you a market related return which is calculated by beta, which is normally using the non-diversifiable risk. So non-diversifiable means which is not in the hands of individuals or companies, which is there. So how much return a portfolio is able to generate corresponding to the risk parameters the market is exposed to. That is what a trainer's ratio is trying to measure. What is the need for having Trainers ratio? It is necessary for us as individuals where I can call myself to be an investor, or if suppose I am in the role of a fund manager, to find out how my portfolio is behaving or performing in response to the risk which cannot be diversified or market risk in other way. Whereas the difference between Trainer's ratio and Sharpe ratio is that Sharpe ratio takes into consideration the total risk, as I told you, both systematic or diversifiable and non-diversifiable risk. So systematic and non-systematic risk both are used over here, whereas here in this particular index we are going to use only market related risk, which is called the systematic risk. And if you are able to do that, I need not go in for a micromanagement. I can very well use it for identifying portfolios or constructing portfolios which are well diversified, which moves according to the market movements and other things. So before I go into the components of Trainers ratio, I would like to help you understand how the Trainers ratio actually function. Let us assume that this is the market return and this is the fund return. A graphical representation of it. And let us assume that the performance is like this. So let us assume this is 10%, 20%, etc., 10%, 20%, etc. Let us assume that at this point, what is the best portfolio which I can select? So whichever market return, let us assume the market return is 15% and the portfolio in which I have invested or I have constructed is going to give me a return of 18%. Don't you think that is a better aspect in comparison to something which is going to give you 10%, market return is also 10% and your portfolio is also 10%. So a comparison between a fund return and a market return is something what we are trying to do in Trainers ratio. Okay, so the different abbreviations which we have used over here is first one is portfolio return, which we have represented as RP. There is risk-free rate of return, which we have represented as RF, and portfolio beta as beta of portfolio beta P. Okay, so these are the different elements which we have which we would be considering while calculating the trainer's ratio. The first component where we talked about portfolio return, what does this portfolio return mean? So it means to say that the return of your portfolio that includes x1, x2, x3, etc., how did this behave in past? So it talks about the historical return, first part, and based on the historical return, I have constructed something which talks about the expected return, right? That's how portfolio return is being component of individual portfolio is being identified and selected. And it includes one important aspect you should understand is portfolio return will include both capital gain as well as the income generated. So capital gain is on the principal amount, whatever gain you have got at the time of selling of that particular asset, that is the capital gain. And income generated is the periodic return which you would be getting on shares. It could be in the form of dividend, or if it is debenture instruments, then in the form of interest. Okay, so all these things are also considered when I am talking about portfolio return. And what is the importance? Importance of this portfolio return is it is talking about the overall performance of my particular portfolio. So I'll come into the remaining part as we proceed. Risk-free rate of return. Already we have seen what risk-free rate of return is when we were talking about CAPM model. It's again the same thing, but it's talking about the return expected in any investment which does not involve risk of financial loss. So what are such type of instruments? Such type of instruments are considered to be government securities or treasury bills. So these are considered to be the return for which no risk is taken by the investor. And the importance of the trainer's ratio, it is very simple. You are just subtracting the risk-free rate of return from portfolio return. Okay, so when I am doing this, I am trying to find out the risk premium, and this risk premium is nothing but a compensation for the investors who is taking some amount of risk instead of staying with risk-free assets. So if I am going to put it over here as this, the portfolio return is nothing but it is portfolio return is nothing but the excess return which it has generated over, I'll put it the other way around. Risk-free rate of return is considered to be the importance of trainer's ratio. The third component which is introduced in the particular formula is portfolio beta. Portfolio beta, it is almost similar to the beta which we have calculated in CAPM model. Okay, it measures the portfolio's sensitivity to market movement. And what does it indicate? It indicates how much the portfolio return is going to give you because of any change which is brought about in the market or overall market. So based on these calculations, it means to say that a beta of 1, it says your portfolio is in line with market, and a beta which is above 1 is highly sensitive to market changes. So here efficient market hypothesis is also to be considered. So it's a combination, you cannot isolate one from the other. So everything goes in line. So beta represents the amount of risk parameters which is existing in the market, which is a combination of different factors. Okay, and based on that, how my particular portfolio is behaving, that is what I'm trying to calculate in portfolio beta. What is the relevance of portfolio beta in Trainer's ratio? It identifies the systematic risk which cannot be diversified. That's the meaning of it, okay, because it's market driven. And what am I doing over here? I am dividing the excess return by beta. So when I'm trying to divide the excess return by beta, what does it say? What is the additional return the portfolio would be generating for each unit of systematic risk? So here the difference you should understand. Sharpe ratio is talking about how much return the portfolio is generating for each unit of total risk was Sharpe ratio, and in Trainer's ratio, the additional return the portfolio is generating for each unit of systematic risk. That's the difference between Sharpe ratio and Trainer's ratio. How it is calculated? Very simple, as we have already seen. Sharpe ratio, it is nothing but the portfolio risk minus the risk-free rate of return. This is nothing but the premium divided by beta of the portfolio. So market risk associated with the different stocks which is there in my portfolio. So that is what beta talks about, right? So I've just discussed about it. The numerator talks about the excess return the portfolio is giving over the risk-free rate of return, and beta is nothing but I am trying to normalize the excess return based on systematic risk. In other words, I am trying to allow the standardized measure of risk-adjusted return to be calculated. What are the advantages of Trainer's ratio? First is focus on systematic risk. So Trainer's ratio is focused on systematic risks. That's first important aspect. And why systematic risk is emphasized? Systematic risk is emphasized because it addresses the entire market. When I'm talking addresses the entire market, those factors which can have an influence on economic changes like interest rate or any other global events like 9/11 or anything of that sort is represented in the overall market, in entire market risk calculation. So that's the meaning of it. And the other important aspect is it is related to the market investment. There is a relevance of market correlated investment. So the idea behind any portfolio construction is to gain out of making investment, and whenever I am trying to make any gain out of investment, I am trying to see from the overall market perspective, right? So I am just trying to compare how my portfolio is performing in relation to the overall market, right, which is represented by systematic risk. And in another way, if I can explain, it is nothing but how the portfolio is compensating for unavoidable market risk which is prevailing in the market. This is considered to be ideal for well-diversified portfolios. And what do you mean by well-diversified portfolio? Is nothing but you are trying to have more number of securities within your portfolio, and when you have more number of securities within the portfolio, then it is considered to be a well diversified portfolio. And the more number of securities moving in different directions or in anything of that sort is part of your portfolio, then you can consider it to be insulated from unsystematic risk. So why it is considered to be insulated from unsystematic risk? Because unsystematic risk is because of companies which is controllable. Okay. So assuming that the number of securities within my stock is more, if there is any risk which is considered to have affected this particular stock's performance because of the management, the more number of stocks you are going to have, the impact would become lesser. So that is the meaning of this. So diversification assumption in trainers indexes, why only systematic risk is considered is because the more the diversity of the stocks, the lesser would be the impact of unsystematic risk. And this is normally very useful when I'm making mutual funds or when I'm talking about exchange traded funds. So under these conditions, this particular index can be used. And it is giving a clearer assessment of market risk. Why it is giving clearer assessment of market risk is because the unsystematic risk impact is minimized over here, and I am taking into consideration the market risk compensation for the diversified portfolio. Now there is this also is useful when I am talking about comparison with benchmark portfolios. So when I have a return for my individual portfolio which is there, it gives me a straightforward comparison between my portfolio with benchmark index like Nifty or Sensex or S&P 500 or whatever it is. So I can compare in accordance with this particular moment whether my portfolio, how my portfolio is behaving. So that's one important thing, and it is considered to be consistent with CAPM model because CAPM model also has aligned itself with the systematic risk while calculating beta. It is considered to simplify portfolio decisions. Why? Because individual stocks, stock management problems or individual fund managers problem is minimized because diversification is more. So when the diversification is more, then what happens is the need for portfolio revision is reduced. And even if I have to bring about any revision in the portfolio, then I can introduce a new stock which is without considering the individual company's performance. You can consider how this is behaving in the market and then introduce over a period of time how it has behaved, and accordingly I can bring about a revision in the portfolio. And if the trainer's ratio is less, what does it mean? It means to say that there is a need for revising your portfolio. So why is this required? It's very simple. If you go into the formula, what does the formula talk about? It is the premium over the risk which you have taken for the portfolio, right, divided by the risk the portfolio has taken. So here it's very simple when I am talking. When the ratio is low, it means to say that beta is, sorry, not alpha, sigma, it is beta. Beta is high. Beta is high means the market risk is higher, right? So if it is equal to market risk, it is fine. If it is less than 1, then it means to say that the market risk is higher in comparison to the portfolio which whatever you have constructed. So the market is not driving the portfolio as such. So it is necessary for you to revisit it and revise it so that you can have a better return as per your expectation. And you can also use risk adjusted target setting. The investors can make informed adjustments such as moving towards less volatile stocks and other things. So, depending upon the value of the ratio, trainer's ratio, I can decide whether I have to increase or decrease the amount of risk which I am going to take, and accordingly identify whether a volatile stock or a less volatile stock has to be part of my portfolio. It also helps me in constructing an optimum portfolio where optimum asset allocation can be done. This is done through beta optimization because of beta optimization, because the return which the investor would be getting on a particular portfolio is based upon the best return which it can give to a particular systematic risk which is prevailing in the market. And it also helps me in diversifying strategy, where I can think about multiple portfolios being constructed for a particular category of investors having different risk level. Okay, so multiple portfolio for one category of investors having different risk level, I can do it, and accordingly I can see based on trainer's ratio whether the portfolio is underperforming or overperforming in construction in relation with beta. What is the limitation of performance index? There is a limitation in terms of assumption of diversification, because unsystematic risk is assumed to be almost zero when I've constructed the portfolio and when I'm measuring it. So there is a problem with this. So it means to say the company's actual performance has nothing to do with the actual price movements which is there in the market, right? So that is one of the limitation of trainer's performance, trainer's ratio. And the second is its dependence to market beta. And as I told you, overall, if you look, trainer's ratio is talking about a portfolio performance in relation to market conditions. Okay, so that's one final thing which you should understand. So in this particular lecture, I have discussed about the second performance measurement matrix which is available for portfolio evaluation, that is trainer's performance index. Thank you.